All right, ladies and gentlemen, first of all, welcome and thank you for joining me today. My name is Brian Stormont. I'm a managing partner at Insight Wealth Strategies. And today we're going to talk about segment rates and how they can have an impact on your pension plan. So when we're talking about pension plans and segment rates, what we're talking about here is a decision where someone has chosen to lump sum their pension. So when you have a pension plan, you really oftentimes have two choices. Now, not all organizations will let you choose one or the other, but many will. So you can either take the lifetime annuity payment, or you can take the lump sum. And the lump sum is essentially the present value of all those annuity payments. And usually that present value amount, what you're doing there is you're generally going to be rolling that over into a qualified retirement plan, either an IRA or a 401k. And then it's your responsibility to do with those dollars what you see fit. But in that decision, one of the things that's very important to consider is what the segment rates are doing. And so today we're going to talk about segment rates and sort of what those trend lines look like this year. And the reason why it's so important right now is that we are entering the home stretch on the year. And for many people, their organization has a segment rate calculation that applies for 1 month for each year and looks backwards 1 year. So what do I mean by that? So right now, if you're working for certain organizations, you are using a segment rate from 2021 if you were to take the lump sum this year. If you wait until 2023, you'll be using a segment rate from 2022. We want to talk a little bit about what those segment rates are doing this year versus last year and how that could impact your overall amount that you receive. So first off, I'm going to share my screen and we're going to take a look at some segment rates and how these all work. So first off here, we're going to see the segment rate chart. Zoom this in for everybody. So what we're looking at here are the different rates that are given to us by the IRS. So every month the IRS issues new segment rates. These rates are not something that are arbitrary or just taken randomly. This is not something that your employer gets to decide upon. It comes from the IRS. And you have the segment rate 1, segment rate 2, and segment rate 3. These represent short-term interest rates, intermediate-term interest rates, and long-term interest rates. And again, what they're doing there is they're using these rates to then calculate the present value lump sum of those annuity payments, assuming average life expectancy. So they're rolling it all into $1 amount right now. And in general, the lower the segment rates are, the larger the lump sum amount is. The higher the segment rates are, generally speaking, the lump sum amount is going to decline. And so for the segment rates right now, what we can see is today, through August of this year, the segment rates are considerably higher than they were a year ago in September 2021. Now, again, many employer plans will require or will have you look at the prior year segment rates to do that calculation. So as we go into the closing stretch of this year, it's very important to understand, does my pension plan look back 1 year on a segment rate calculation? And then ultimately, am I in a position where I can afford to retire and it's going to behoove me, it's going to financially benefit me to move out, to leave the company before the year closes out? Because if I wait until 2023 or later, I may be losing out on these very low, potentially historically low interest rates on that calculation versus what could be rising or even higher interest rates. Right now, we know what the segment rates are through August. Any day now, we'll be getting the IRS segment rates for the month of September, but it's quite likely that those rates are going to continue to climb. This is the yield on the 10-year Treasury. This is coming to us from the Wall Street Journal website. And you can see that all over the last year, all year long, the yield on that 10-year Treasury has been rising. Now, getting a sense of where broad interest rates are moving for the bond market is not exactly the most precise science. You know, you can always see what a stock price is worth, but with bonds, a little more challenging. But the 10-year Treasury is a really good proxy for where things are at. And you can see where we were at the beginning of the year. We were about 1.5% on the 10-year Treasury at the close of last year. As of today, you can see we're all the way north of 4%. So yields are rising. That means segment rates are going to be going up too. And so that is critical. Our job here at Insight is to sit down with our clients and figure out holistically, what does that mean for me in terms of the lump sum versus the pension? Should I take the lump sum, or maybe I should take the pension? And in addition to that, we are a holistic financial planning firm. So we do comprehensive retirement planning, we do wealth management. We also do risk analysis for our clients to figure out, do you have enough life insurance, or can you afford to maybe reduce that? Should you consider long-term care coverage? And then lastly, on the estate planning side, do you have everything accounted for there just in case, God forbid, something were to happen? Are your affairs in order? And so with that said, ladies and gentlemen, what we want to reinforce here today is the reality that the segment rates are likely climbing. That window of opportunity to potentially take advantage of those low segment rates may be closing, and it might make sense for you to take a look at your pension plan and figure out, is this the right time for you to consider making a change? Here at Insight, we get inquiries like that all the time. Just about a week or so ago, we were working with a woman out of Ohio. She saw one of our earlier webinars on the segment rates and was curious about how it might impact her pension plan. She may or may not ultimately end up being a client, but we're happy to spend some time with her or anybody else going through their plan, helping them understand how it impacts them personally. So I would encourage you to feel free to reach out. We are located here in Northern California in the Houston area in Texas, but we have clients all over the country, and we're more than happy to have a chat. Again, my name is Brian Stormont. Our firm is Insight Wealth Strategies, and we look forward to the opportunity to working with you. I hope you have a great rest of your day, and please feel free to reach out and give us a call if you think you might have any questions, okay? Thanks so much, guys.